Transparency is a big thing for this channel. So today what I want to do is walk through my portfolio for the month of January and the first couple of days of February because the week ended on February the 3rd. So this will be from the beginning of January all the way through February the 3rd. I want to talk about the things that I bought, the things that I sold, the dividends I received, the interest I received, and that's going to be kind of an interesting point. And also, I'll kind of scroll through my entire portfolio. I won't talk about every stock, but I'll scroll through, and that way you can, stop the video or whatever and take a look at every investment that I have in my portfolio. So if that's something you're interested in, stay tuned. Hey guys, Kevin Burgess back again with another video. So before I get started, I recognize that the quality of this video is not as good as normal. And I'm using another laptop this time. I'm actually away from home, and this is the equipment that I have to use. So I will certainly get this fixed before the next video. So it's there, it's just not as crisp and clear as you're used to seeing. So we'll get that fixed on the next video. But today, I want to talk about my portfolio. I want to talk about the performance in January. We underperformed the market in January. And I want to talk about the things that I've learned, maybe not learned, but relearned about what caused that in January and how I should look at that as an investor. So we're going to look at every part of my portfolio. We're going to look at the purchases, the sales, the dividends, the interest, and any kind of market movements. And so I think that should be interesting. And the reason it's interesting is not because you should mimic my portfolio. It's always good to look at what other people are doing, not for the purpose of mimicking that. I don't share this so that you will go and buy the stocks that I have. I share this so that you can see what I do, why I do it, how I do it, and then you can either take pieces that you like and put that in your process, or you can say those are things I'm not going to do and eliminate those from your process. But either way, the purpose of this is to help you be a better investor, whether it's not doing the things that I do or whether it's doing the things that I do. I just share this so that you can get better at your investing process. So the S&P is up about 8% year to date through February the 3rd. That's a pretty big jump. I mean, if you think about 8%, if they do that for every month of the year, that's going to be about 100% growth in the S&P 500. I'm not expecting that to happen. I think there was a bit of a roll here in January. And however, my portfolio moved a little bit more than 2% in the month of January. Now, if you take 2% and multiply that times 12, you get 24%. In any year, I would take 24%. But the thing that is hard to swallow is that compared to the market, we didn't go up nearly as fast. And so I want to talk through some of the reasons why. So there's a couple of mistakes that I made, and it's mistakes that I know I shouldn't make, but I did anyway. In full transparency, I want to share that with you guys so that you can see that no matter how long you've been investing, sometimes you just got to go back to the basics. So with that being said, let's go ahead and get into the portfolio and see everything that I did this month. So first of all, let's take a look at the S&P 500, which is usually what I use to benchmark my portfolio with. You can see on Friday that it went down about 1%. But on a year-to-date basis, so this will be January 1 to February the 3rd, it's up about 8.17%. And again, compared to my portfolio, which went up about 2.2%, the S&P 500 really outpaced us in the month of January. So let's take a look at my portfolio. As you know, I've got now 4 portfolios inside my overall portfolio. I have a dividend growth portfolio, which is really focused on companies that I believe over a long period of time will be growing their dividend very quickly. I don't get concerned as much about yield in this particular portfolio. I'm looking for dividend growth that I think is going to be sustainable over the long term. The second one is dividend income, and I'm looking really more for yield in this portfolio. I'm not as concerned about dividend growth. I do want some, but I don't, seek out growth in this portfolio. I seek out yield that I believe is going to be sustainable over the long term. I'm not chasing yield here, but I look for companies who are giving a good amount of yield based on the value of their business. And then I've got a snowball portfolio that's very small. It's about $3,000. I'm more than likely going to roll this at some point into my income portfolio just because it's difficult to keep up with for me. And I'm not sure it brings much value to you as a viewer. Then I've also added a Roth IRA into my portfolio, and this is actually going to be pretty cool because it's going to focus on REITs and BDCs because it's a tax efficient way to invest in REITs and BDCs. So I want to talk about each of those today. Let's start with the dividend growth portfolio. Let's take a look at how each of the investments performed over the last, let's say, 1 month. I'm going to sort this in with the downside being on top. So my worst performer for a 1 month stretch of time is Johnson & Johnson. So Johnson & Johnson is down 7.6%. Air Products is down 7%. General Dynamics was down almost 7%. Pepsi was down almost 6%. Lockheed Martin down almost 4%, and Aflac down right around 3%. So then when I look at other stocks, EOG pretty much break even. Atmos Energy was up 5%. Cummins up 6%. And you can see that there's several stocks that went up in this particular portfolio. With the ETF SOX, which is my chip ETF, was up about 24%. Texas Instruments was up only 12%, so that's not too bad actually. And we look at stocks like Stanley Black & Decker. Even though I'm still down on Stanley Black & Decker a significant amount, it went up 23% in the month. So I had some stocks that did really well, and I had some stocks that didn't do so well. And in this particular portfolio, which is my dividend growth portfolio, it went up about 4% overall. So, not too bad, actually. Let's take a look now at the dividend income portfolio. This is sorted in the worst order first and the best last. AbbVie went down about 11%. So this actually drove some of the underperformance in my portfolio. IBM was down 3%. Chevron was down almost 3%. Hess Midstream, pretty flat. And then, we had some low returns, from Philip Morris, Kinder Morgan, Pinnacle West, and Altria Group, Verizon as well. So AT&T actually performed pretty well, almost 6%. So you can see T. Rowe Price up 15%. Fidelity National Financial up about 18%. And Franklin Resources up almost 23%. So those really helped to offset some of what we saw on the bottom end. However, it's important to point out that the top 4 holdings in this portfolio, in this income portfolio, is IBM, Chevron, Pinnacle West, T. Rowe Price. So I'm not going to spend much time then on this. I'm not going to look at the snowball account at all. I will spend a couple of minutes on the Roth IRA. If you're not aware, I've begun to buy some REITs, and I've got a video on that. If you wanted to take a look at that, I will post that at the end on the end screen. And you can see that the 1 month performance here is actually pretty good. I mean, I've got, one at 19%, one at 12%, one at 9%. The lowest one is National Retail Properties, which only moved about 3% higher over the last month. So the REITs actually did very well. Okay, so here's some of the activity, and this is point number 1 of when I looked back and did kind of an analysis of really what happened for the month. I wanted to refresh your memory that I sold out of some companies here. I sold out of Whirlpool in the dividend income account. I sold out of Verizon. I sold out of Prudential, and I sold out of Main Street Capital on December the 30th. And the reason I did that is not because I dislike these companies. It's because I needed to be able to harvest those losses for the 2022 tax year. So I went ahead and sold out of those. And at the same time, I ended up buying some T. Rowe Price, which was a good move, and some AT&T, which was also a good move. However, I did not reinvest all of these funds. I'm sitting with about probably 10 to 12% of my portfolio in cash. Normally, I want that to be less than 5% in cash. So, key lessons number 1 and 2, don't try to time the market and stay invested. Now, this is not my first rodeo. I know that it's important to stay invested. I know that it's important not to try to time the market. And I didn't make this transaction to try to time the market, but I left myself unexposed to the market, expecting the market to come down when the earnings came out in January. That didn't happen. So I had about 10 to 12% of my portfolio sitting around doing nothing while the rest of the market was going crazy. So, key point number 1 for me is, regardless of the reason for selling shares, go ahead and reinvest those in other companies so that we don't have that market risk out there. Now, it could have just as easily have gone down, and then I would have been touting how good of an investor I was. But at the end of the day, it would have all been luck and not strategy. So point number 1 is, don't try to time the market and stay invested. I guess that's 2 points, but you get the point. So point number 3 is, dividend stocks will usually underperform when the market rises and will usually outperform when the market declines. And this makes sense because dividend stocks typically have lower beta, which means that they have lower volatility. So as the market rises quickly, the dividend stocks won't rise as quickly. And as the market drops really quickly, the dividend stocks won't drop as quickly either. So it's a bit less of a rough ride. But when the market runs like this and you're comparing yourself to the market, it kind of makes you wish you had that market exposure. But as the market ebbs and flows, it's gonna pretty much balance out in time. And then the last thing is that dividends continue to roll in regardless of the market value. And dividends are a key part of our investing strategy. So let's keep that in mind. So those are the 4 points that I learned from my January's portfolio performance. I thought I would just share that with you, full transparency. Now let's take a look at some of the other transactions for the month. So on January 18th, I bought into 6 REITs. I did a video on this that I'll put at the end screen. You can take a look at that if you'd like. I bought Digital Realty Trust, Essex Property Trust, Kilroy Realty Corp, National Retail Properties, National Storage Affiliates, and Realty Income Corp. I'm going to hold the rest of the Roth IRA funds for a good entry point into Main Street Capital Corp. And I think that'll round out that Roth IRA really nicely. Now let's take a look at the February 3rd transactions. I did buy Johnson & Johnson on February the 3rd. And I'm going off memory here, but the court denied their attempt to create this bankruptcy corporation so that they can, put the liability into this bankrupt corporation and fund it with a certain amount to try to limit their liability. The court said, no, you can't do that. But as I look at Johnson & Johnson, and I look at that talc liability, I think that, it's really undervalued at the moment, and not significantly, but it is undervalued. So I went ahead and picked up some shares of Johnson & Johnson, and then also got back into, because my time frame had ended, and I got back into Verizon in a small way. I went ahead and bought 100 shares. My original position that I sold in December was 1,000 shares. So, I'm beginning to enter into Verizon again, but on a slower scale. I'm not just going in and repurchasing all of those shares. Now let's take a look at the dividends for the month. So I'm going to start back here in January 6th, which is on the bottom of the screen. We received $83.23 from Pepsi. I got $235 on the 10th from Altria Group. I got $146.05 from Philip Morris, ticker symbol PM. And I got $30 from my investment in Franklin Resources, ticker symbol BEN. Now, this is going to be kind of interesting, I think, for you guys. On January the 31st, you will notice that I have dividends received from these money market funds. There's one, two, three, and then there's a cash reserves fund. There's four funds that I've received money from. So part of the good side of having a lot of cash on the sideline is that I also got a lot of interest. And so you'll see here that I got 2 cents on the dividend snowball account. I got $95 from the Roth IRA cash. The dividend income account, where I had most of my cash, is $325. That's a pretty significant dividend without a lot of risk. And then when I look at the dividend growth account, I got $130 from that. So, talking about probably over $500 just in interest on the cash that I had in the money market funds. Then on January 31st, F&G Annuities and Life, which is the spinoff of Fidelity National Financial. I owned 6 shares of that, which was a dividend that they paid out, a stock dividend. And I got $1.20 from that. So a free $1.20. Then I have EOG paid 179.84 on January the 31st. And on February 1st, my AT&T shares paid 138.75. So for the month, I got about $814 in dividends and a little over $500 in interest. So it was actually a pretty good month. I'll take that, pretty much any time. So as promised, let's take a look at my portfolio. You can see that the overall portfolio is about $957,000. Annual income from that is about 27%, which is a yield on cost of about 3.64%. I do break this down into 4 different portfolios, and we've talked about that before, but it's important for me to tell you, and I may have mentioned this before, but for me, I track my portfolio in Simply Safe Dividends. And what that allows me to do is take my 4 different portfolios and it will actually consolidate the holdings so that I can see what exposure I have to any particular stock. So if I buy T. Rowe Price in both my dividend growth portfolio and my dividend income portfolio, it's going to consolidate those investments and show me overall what my exposure is to T. Rowe Price. So I really enjoy this portfolio management tool that's inside of Simply Safe Dividends. It's one of the reasons that I actually pay for this service. So just to point out, it allows me to look at my diversification so I can see that I'm a bit overweight here on industrials, but with so much cash sitting on the sideline, I think once that's reinvested, this is going to come back to below 25%, which, I'm fine with. Okay, so let's kind of roll through these stocks. Right now, they're sorted in alphabetical ticker order. I'm going to sort them in descending percentage of portfolio order so that you can see what my highest stocks are, or what my highest concentrations are, and what my lowest concentrations are. So my highest concentration is in Cummins. It is 6.7% of the portfolio. It's up about 30% since I bought it. And it has a 98 dividend safety score. So it is really rocking for me. Lockheed Martin is 6.5% of my portfolio. It is up 36%. So I may consider moving this back down to about 5% and selling off maybe 20% of the shares, 15% of the shares. I currently have right at 135 shares. So, I may back down by 15 shares or something like that along those lines and create some cash that I can then use to invest in other places. Stanley Black & Decker is at 5.5% of the portfolio. I am down 22% on that, even though it had a great month in the month of January. I'm looking for some time to get into that and average down. Obviously, I could average down now, but I think, with it trading in the $93 range, I'm going to try to get that back into the 80s before I try to average down anymore. I don't have a lot of opportunity to do that. I don't want to go too much above 5%, but I will if I think the opportunity is worthwhile. And you can see that Johnson & Johnson, my fourth largest stock holding at 5.2% of the portfolio, I'm about break even on that. So I went ahead and added to that position. Now I have about 300 shares of Johnson & Johnson. Whirlpool is next. And again, I'm down 20% on Whirlpool. I believe both Stanley Black & Decker and Whirlpool in the long run are going to perform very well. I am considering opportunities for both of these to average down on, but again, they are a pretty high number in my portfolio, and I don't want to do that until I get a really good, entry point. You can see Texas Instruments is about just under 5% of the portfolio. It's up 10% overall. T. Rowe Price, I'm glad I have it up now, to about 4.3% of the portfolio. I am planning to move it higher based on, opportunities to buy shares. 125 is a little bit high for me to be adding that. My cost per share right now is about 112. So I'm going to be patient there and add T. Rowe Price when it makes sense. But I do believe that's going to be a good stock for me moving forward. The dividend yield is 3.81%, but the yield on cost is 4.3% with a safety score of 94. That's really, really nice. You can see that IBM's 4.3% of the portfolio. I am up on IBM, but it did have a bad month of January. Microsoft, I'm down 10% on that. I am also going to look to average down in Microsoft. And then I won't talk through the rest of these, but I will scroll through them so you can see what they are and what my holdings are and what percentage of the portfolio it is. You can see the shares that I own. You can see the cost per share. So you can see my yield on cost and dividend safety scores and all of that here on this particular screen. So I'm just going to scroll through this and let you see that portfolio until we get down to my last position, which is none other than FG, which is a dividend that I got it was a stock dividend from Fidelity National Financial. So I actually got shares of a company called F&G Annuities and Life. It's 6 shares. It's not even measurable on my portfolio, but it is kind of cool to have those 6 shares and be up 13.7% on an investment that I didn't even make. So I think that's pretty fun. And you can see here that I am sitting with about $155,000 in cash. I know I said 12% earlier. I had forgotten about the cash that I had in the IRA account waiting on Main Street Capital. So when I factor that in, it's really more like 16% cash that I have in the portfolio. I will be bleeding this down and back into the portfolio over time. So when I do this monthly update on the portfolio in February, don't be surprised if you see that I've made quite a few transactions. But again, it's going to depend on what the market is doing, what my particular stocks are doing, and whether I feel like it's the right time to enter those transactions or not. So hopefully you got something out of the review of the portfolio. I try to be transparent. I want to show you everything, even if it's bad. I want to show you not only the good, but the bad. And when you've been investing as long as I have, there are times that you sometimes, even though you know that you're not to time the market and that you should stay invested, sometimes it just doesn't work out that way. And so it's good to have that reminder, that refresher that reinforces the good traits that we're to have when we have a portfolio of investments. So January was a key learning period for me, and I'm glad to get that refresher course. And if you're new to dividend investing, or if you're new to this channel, I appreciate you joining today. I'm glad to share all of this with you. If you want to see more videos like this moving forward, consider subscribing to the channel. I'd love to have you along for the journey. And with that, I'm going to see you on the next video.